Hi everyone, welcome to Charts in Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX Verify. In this video, we'll look at the major economic data points from the week of April 6th through the 10th. It's a bit of a good news, bad news story. Markets are showing some optimism about de-escalation in the Middle East, but the underlying data shows we aren't out of the woods yet regarding inflation. First up, let's talk about the I word. Consumer inflation just hit 3.3% in March. That's a near 2-year high. While it was slightly better than the 3.4% we feared, it's a huge jump from February's 2.4%. But the real sticker shock is the monthly number. Prices rose 0.9% in a single month. To put that in perspective, that's the largest monthly gain since 2022. And what's driving it? Just look at the gas pump. Energy costs accounted for 75% of this gain. If you strip out food and energy, core inflation only rose 0.2% on a monthly basis and ticked up slightly to 2.6% annually. The Fed's favorite metric, the PCE index, tells us that this heat started before the recent Iran conflict. We saw a 3% year-over-year rise in February. With gas prices now surging past $4, we're bracing for a very sharp spike in the March PCE data when it drops. While prices are going up, growth is cooling down. In the final months of 2025, GDP growth slowed to just 0.5%. That's a massive drop from the 4.4% we saw in the third quarter. We're entering a period of stagnation risk. The economy is propped up by consumer spending, but with government spending and exports falling off, the margin for error is getting incredibly thin. Unsurprisingly, consumers aren't feeling great. Sentiment hit a record low this month, plunging 11%. People are feeling the pinch of geopolitical instability and those higher gas prices. Even though a ceasefire was announced, the pessimistic mood was already baked into the data. But the real concern for the Fed is inflation expectations. Near-term expectations jumped from 3.8% to 4.8%, the biggest one-month leap in a year. Long-term 5-year expectations also rose to 3.4%. And when people expect prices to keep rising, it can become a self-fulfilling prophecy as they change their spending habits, making the Fed's job of cooling the economy even harder. Despite all that, the S&P had its best week since November, up nearly 4%. Why? Investors are betting on peace. Interestingly, the market is 98% sure the Fed will hold rates steady. The pivot has been pushed further over the horizon. Current pricing suggests the Fed will stay flat through all of 2026. We aren't looking at potential relief in the form of rate cuts until 2027. This higher for longer reality is the new baseline for investors. To wrap things up, we're seeing a fascinating and somewhat risky divergence in the numbers. On one hand, the economic data is a reality check. We just saw the largest monthly inflation gain in years, and growth has nearly stalled. On the other hand, the stock market just had its best week since November, rallying nearly 4% on the hope that geopolitical tensions will ease. This creates a high-stakes environment. Investors are essentially betting that peace will outweigh the higher for longer interest rate reality that the Fed is signaling through 2026. Keep an eye on that gap between market optimism and economic data. It's likely to be the biggest story of the quarter. That's all for our discussion. Thank you for tuning in. We'll be taking a 3-week hiatus, but as always, you can find all of our economic and market analysis on the Advisor Perspectives website under the AP Chart section.